If you're new to investing, these three words come up everywhere. Stock, ETF, mutual fund. They sound similar, but they are very different things. Let's break them down without jargon. First, a stock. When you buy a stock, you're buying ownership in one single company. If you buy a share of Apple, you own a tiny piece of Apple. If that company does well, the value of your share can rise. If it struggles, the value can fall. Stocks are simple to understand, but they can feel uncomfortable for beginners. Because everything depends on one company, that's where ETFs come in. ETF stands for Exchange Traded Fund. An ETF is a basket of investments wrapped into one. Instead of buying one company, you're buying many companies at once. For example, an ETF might hold hundreds of large US companies all inside one investment. When you buy an ETF, you still own shares, but your risk is spread out. ETFs trade on the stock market just like stocks do. You can buy and sell them during market hours. For many beginners, ETFs feel calmer because you're not tied to the success or failure of one company. Now, mutual funds. Mutual funds also hold a basket of investments. On the surface, they sound similar to ETFs. But here's the key difference. Mutual funds are usually managed by people who decide what goes in and out of the fund. They don't trade during the day. They're typically priced once per day after the market closes. Mutual funds often come with higher fees and are common in workplace retirement plans. So let's simplify this. A stock is ownership in one company. An ETF is ownership in many companies, traded like a stock. A mutual fund is a pooled investment managed by professionals. One isn't automatically better than the others. They're just tools. The mistake beginners make is buying without understanding. Once you do, it all starts to make sense.